from the bank and say, could you do me a favor, would you send me one directly from the home office rather than going through the person who's trying to raise the money? If you are made to feel uncomfortable about questioning the investment or asking about the investment, then you should be very skeptical. In fact, in most Ponzi schemes, they tell you it's on the quiet. You have to be quiet about it. It's on the side. The reason why they do that is they don't want an inadvertent discovery. And oddly enough, for a lot of Ponzi schemes, that's how it begins. If it's too good to be true, it probably is. This is a good platitude. The problem is it's a platitude. And like all platitudes, they're subjective. So people generally do not follow. Don't judge a book by a cover. An apple a day keeps the doctor away. It's your job as investors to seek the best benefit, to look to try to minimize your risk and try to gain assets. The line between that and what's too good to be true sometimes gets blurred. So because of that, that platitude sometimes does not hold up. Every time over the last year when I've seen people discussing different frauds and saying, it's the client's fault, it's the victim's fault, it was too good to be true, they should know that. None of those people said, that was too good to be true, but I'm just going to take the risk on it anyway. Some of those people had concerns and thoughts, but didn't take it any further. The problem with being subjective is you don't know where the line is. You couple that with the fact that a lot of the investors who had high net worths that got hurt were very successful through their ingenuity and hard work and fortune, and for their taking risks. They achieved what was too good to be true. And what they then do is they project that. They project that on other people, especially those that they trust who are trying to gain their money. And when they project that, they lose all subjectivity of what is too good to be true. If you look around this room, you look around this hotel, you look at this island, picture 120 years ago when someone had said this would have been here. The quote would have been too good to be true. So people know that occurs once in a while, and therefore they don't pay attention to it. So what do? Seek guidance from another independent third party. If you're offered something that you look at and you become questionable, go to another investment advisor, go to your accountant, go to your trust office, go speak to someone else and say, this is what's being offered to me, what do you think? They'll be happy to talk to you. If you decide to do it, there's never been a broker who said, well, how dare you not put the money with me? Or there shouldn't be, and that's another sign if you have that issue. But do it. You have to protect yourself. Now, let's discuss economic, financial industry, general fraud that happens in brokerage accounts. And there's a couple caveats to start. In the past, we look and say they're regulated, so why do we have to be concerned? We've learned, of course, over the last couple of years that in the present, the question now becomes, okay, what do we look for? First, just because you lose money in an investment does not mean that the broker, brokerage firm, and investment advisor has done anything inappropriate. But inverse, just because you haven't lost money in the investment yet, or the investment seemed to grow, does not mean that you are properly or suitably invested. It's insidious, because instead of taking the whole amount and running, they take little pieces which dilute or reduce your principal over a long period of time. It could be often hidden by market appreciation or excused by market depreciation. Broker says to me, Craig, I'm sorry you lost 50%, but the whole market's down 50%. That in of itself is not an excuse. If it's Craig the speculator, fine. If it's Craig's grandmother living on a fixed income, it isn't. These occur in brokerage accounts, trust accounts, and even with investment advisory firms. Let's address each one. First, the sale and recommendation of unsuitable securities. Suitability is different from each and every one of you. And it really relies upon many factors, but we'll discuss the top 4 here today. First, what are your objectives? Is it capital preservation? Is it capital appreciation, growth, income, speculation? Every one of you has a different one. And that's how the investment advisors or brokers should review it. What are your risk tolerances? On most opening account documents, it has information that says you can't lose anything. You can lose 10, 20, 50%. Put all your money at risk. It's important to know which they are and to make sure that your broker is following those. Types of investments, equities or debts, municipal funds, annuities. They're all different, and it's different based upon your objectives. Sophistication does not equal wealth. The best way of showing this is if tomorrow every one of you and I hit the lottery and win $100 million. That does not make you more sophisticated. Attractive, yes, but not more sophisticated. Diversification and overconcentration. The stock market in the past year and a half has gone from 14,000 down to 6,700, back up to right now around near 10,000 again. If you are equally diversified across, you've come back. If you are not, and you are over-concentrated in certain investments, you don't get a second chance. Within the past year, there have been individual S&P 500 stocks, many of which that we all knew as brand names, large corporations, multinational corporations, that are gone. If you were over-concentrated in those stocks, saying, well, it's a giant corporation, I'm okay, the money's gone, once again, no second chance. Individual sectors, if you're over-concentrated in, once again, it causes a lot more volatility when the market decreases, and you may not get a second chance. Types of investments, equities versus debt, and any type of other type of investment that relates should be diversified. And then there's something the brokers can do that you can go speak to them about called hedging, which is for some individuals who can't sell the stock because it's restricted, you could speak to them about hedging to help protect from the downside. Churning. I once had a judge say to me, what is that, like churning butter? Essentially, it's excessive trading in a brokerage account just to generate commissions. There's two parts to it. Number one, who controls the account? Does the broker de facto control the account, or are you calling up every day and saying, buy this, sell this? If you're doing that, chances are it's not churning. And the second, there's something called the Looper formula, which says that, generally speaking, if in your account, every 2 months, all the transactions turn over one time, it's per se churning. Unauthorized trades. This is an interesting one. Some brokerage firms allow, with written discretion, your broker to purchase, buy, and sell stocks without speaking to you first. Without that discretion, though, the broker is not allowed, pursuant to FINRA rules, which used to be the NASD, and pursuant to their own brokerage firm requirements, trade stock. They are allowed to do time and price discretion, but not the individual stocks. So if you have a broker that calls you up that doesn't have discretion, say, I bought this for you, I think it would be good. Without that discretion,